by the idea that geopolitical tensions are rising.
A new week, the same tragic story. From New York City this morning, good morning, good morning. Futures recover down just 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. The war in Ukraine intensifies. The devastation in the country pushing Secretary Blinken to prepare for the next step up in sanctions.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure that there is still an appropriate supply of oil on world markets.
Germany so far says no, leaving the White House under mounting pressure and facing tough decisions. Bloomberg reporting they could go it alone, writing, quote, the Biden administration is considering whether to prohibit Russian oil imports into the U.S. without the participation of allies in Europe, at least initially, according to two people familiar with the matter. Oil jumping overnight, surging as much as 18% before fading through much of this morning. Your team coverage starts right now with Bloomberg's Anne-Marie from the White House and Maria Tadeo in Brussels. AMH, set the stage for us.
Well, Jonathan, you really outlined it there, the fact that the United States might have to do this unilaterally, because we just heard from Olaf Scholz, the Chancellor of Germany, that they're just not there yet, and that Russian energy is just so important and essential to the European economy that they are looking for supplies, but it's not going to happen overnight. But, Jonathan, we should really note that even if the United States does take this stand and ban Russian imports of oil and other fossil fuel products, they're going to be behind the market, because for days there has already been an embargo, just not in name.
Maria, what I've heard from the Germans this morning is no from the finance minister and no from the chancellor.
Yeah, and they both control the money, so that just gives you a very clear indication of where they're going. And in fact, I just want to focus on the language that is coming out of Germany today. Chancellor Scholz says in a written statement, so there is no loss in translation here. These are the words on paper. He says there's a reason why energy has been exempted from these sanctions. It is vital, quote, for heating, electricity, mobility, and industry across Germany. Now, the question is, does Germany want to break away from this dependency on Russia? Of course, I'll tell you the answer would be yes. In an ideal world, we could just flip from one day to another, but there's an economic reality behind this, and this is a transition that you can't switch off overnight. So the mood music coming out of Germany is very different. They say we've exempted Sberbank and Gazprom from these sanctions for a reason, and it seems there is no turning for the time being.
Well, let's talk about the range of talks we've got today, including the talks between Ukraine and Russia, and then the American president speaking to European allies a little bit later too. Maria, I want to start with you and what we heard from the Kremlin spokesman in Reuters a little bit earlier this morning, basically coming up with a list of demands. I'll read them as follows. Cease military action, change the constitution to enshrine neutrality, acknowledge Crimea as Russian territory, and recognize the separatist republics of Donetsk and Luhansk as independent states. Now, Maria, your interpretation of what we heard from the Kremlin spokesman to Reuters this morning.
Now, here's the thing. When you look at the actual wording, you could argue the language is softer, because up until now, the Kremlin, remember this, they talked about a government that was full of Nazis. They talked about denazifying the country. They talked about Zelensky and his government being fascist and drug addicts. So the language, the envelope here has changed, and you could argue it's softer. The point now, however, is that the Ukrainian government is going to have to make a painful decision. Do we accept this, which on paper may seem softer, but there's no majority, let's make this very clear, to change the constitution as it stands right now in Ukraine. And we've seen this nationalistic almost fervor in the country as a result of war, where they say we will never forgive and we will never surrender? Or does he feel this is better than a full-on war that could last for weeks? Now, that is a question in the mind of Zelensky. Right now, we have no indication that he's willing to U-turn from his initial position. Having said that, we know there's talks that are currently ongoing between the two delegations, so we could get a hint later today as to whether this is something the Ukrainians can work with or not. But until now, there is no indication that Zelensky is planning on backing down down any moment.
AMH, the president speaking to Macron, to Scholz, to Johnson a little bit later. What's the focus of those talks?
Probably going to be an update on where they stand, Jonathan, in terms of the sanctions, as well as any more aid they can deliver to Ukraine. You know, we have lawmakers back in session this week, and there's a lot of political pressure to do more for the Ukrainians, especially given the fact that President Volodymyr Zelensky joined a number of senators and lawmakers on Saturday on a Zoom call calling for more action. So I imagine that's where it's going to stand, and potentially, Jonathan, they'll talk about the energy issue, because right now, that's where the divergence is.
Anne-Marie, thank you. Always great to catch up with AMH. Stay close through the hour, Anne-Marie. We'll touch base with you again. Maria Tadeo out of Brussels, thank you. Your equity picture improves as this session grows just a little bit older. To discuss, Evercore's Julian Emmanuel, TPW's Jay Poloski, and Victoria Green of G Squared. Victoria, first to you. Can you help me understand the kind of price scenario that we're priced for right now in the commodity market? Are we already looking at Russian crude out of the market at 120 on Brent, 117 on WTI?
Sure, and I think people are already, like they talked about, self-selecting. You have the ports and the dock workers union in the UK refusing to unload Russian crude from a German flagged vessel. You know, you're seeing this kind of rise up against Russian crude. United States may go it alone because we're a little bit better supportive of our own domestic production here. Like you showed before, it's only about 3%, 8% total if you look at all the oil and gas and fuels. And we can kind of absorb that, maybe continue to see our domestic producers ramp up production here. When you're talking Germany and the EU, which gets about 40-50% of its gas from Russia, or even Japan, which Russia is their fifth biggest importer, and they import a lot of their energy, it's just a different economic conversation than what we're seeing here.
Jay, is this a one-way ticket towards demand destruction?
I'm not sure, John. I mean, I think that Russia has occupied the headlines, obviously, for the last week or two. To me, the much bigger story is the story of COVID ebbing and the reopenings around around the world, from Asia to Europe to the United States. To me, that's a much bigger picture, and global growth, the way I'm looking at it, remains pretty decent and able to handle this. I do think we have priced in some embargo of Russian oil, at least, if not gas. And we've also seen nuclear in the headlines, and so we're discounting even that. I think we're very close to being finished with the downward price action from Russia.
Jay, isn't this just the same version with a different smell? Same messy supply chain issues, same story with prices, they're going higher. For the market, aren't we just replacing COVID with the tragedy of what's playing out in Ukraine and what it means for supply chain and prices?
No, I don't think so, John. I mean, I think, to me, Russia, it is a tragedy what's happening in Ukraine, but Russia has done the global investors a favor. And that favor is they've taken out the risk of an aggressive Fed. The aggressive Fed was the biggest risk to global risk assets. The Fed was going to have to tighten until something breaks, namely the equity market. That risk has now been taken off the table. COVID is not even in the discussion. It is by far the single biggest factor, and it's going to lead to lower than expected inflation because people go back to work, because supply chains unsnarl. And it's going to lead to better than expected growth because you have the service segments of the European, U.S. economies, Asia, et cetera, reopening. Europe had record low unemployment in February, John, with the service segments of virtually the entire continent still shut. U.S. job numbers were way better than expected without COVID having fully ended.
It tells you a lot about where we've been. I'm not sure it tells you much about where we're going, Julian. We're going to a world where we could have crude north of 100 for a more sustained period of time through the year ahead. I'm not sure it's necessarily good news just because the Fed doesn't have to hike. We have to talk about the reasons why the Fed's not going to hike by the magnitude that maybe we were talking about a couple of months ago, Julian. Isn't that equally as important?
It is. Look, Evercore still thinks the Fed's going to hike 6 times this year. Okay. The issue is that whether you look at it in terms of consumer sentiment versus the spend, and the consumer sentiment has been very sour in recent months because of inflation, yet the spend has been strong, perhaps because of the anticipation of inflation, among other things. You have to reconcile all of these things, and that keeps the Fed looking at, really primary goal now, trying to make sure that inflation expectations don't get unanchored. And obviously, the other issue is this geopolitical risk could be the precipitating point where, in fact, we do think that you're going to get an element of demand destruction. We just don't think it is going to tip the country into recession.
I wonder what that means for the energy names. Victoria, you've been very constructive on them. They've done tremendously well through the year so far. At some point, though, crude goes too high, even for energy equities to keep rallying. At what point is that in our future?
Sure. I mean, oil over 100 is unsustainable, right? That's always been the tipping point. You look at the 90s with what we did in Iraq and Kuwait, and then we look at it happened in 08. Oil over this level is never a good thing. It's too much of a drag. We're about to hit our 08 high in gasoline prices at 411. I think we're going to blow past that. You're probably going to get 8% print on inflation, and this is just a drag on the consumer. We still like energy stocks because the bulk of ours are more domestic focused, and even BP and Shell with their divestments in European and Russian energy, they're still weathering fairly well. So even if oil comes back down, and hopefully it will, because that's a much more sustainable for economic growth, these have break-evens in the 40s in the Permian Basin. So we still think oil and energy is a good place to be, but we are wary commodities are 100% in a bubble. Look at what happened with wheat this week. WTI was up 25% last week. I mean, it was insane.
The gains year to date, 55% on Brent and WTI. Looking at the year to date column on the Bloomberg, it's just ridiculous, the price action we've seen. Jay, Julian, Victoria is going to stick with us. Secretary Blinken speaking at the moment over in Latvia, saying the United States does not want Russia and the conflict to widen, broaden. We know that. Reiterates something we've heard a few times now. Blinken saying the United States does not want the no-fly zone. The U.S. reiterating they do not want a no-fly zone, something the Ukrainians have pushed quite hard for. Your equity market, that story improves. Futures are negative, but certainly not as negative as they were earlier this morning, with some movers going into the opening bell. Here's Abby.
Hi, John. Well, yes, tremendous macro movement in the pre-market here for stocks, well off the lows, down just about 0.2%. Earlier, down 2%, as you know. And oil, it's really incredible, up just 1%. Earlier, it had been up 13%. Nonetheless, we still have energy as the top sector. Occidental Petroleum up 5%, and really an illustration of how two sides make a market, with Icon exiting Occidental Petroleum. And we have Berkshire boosting. Transocean up just 2.8% earlier. Both of these stocks up 9% when oil had been soaring. On the other hand, you have Citigroup down 2.8%. This as it has been downgraded to Jefferies to a hold from a buy on the company's targets provided in a recent analyst day. And then United Airlines, not surprisingly, airlines down, John, down 2.3%. This, of course, as jet fuel costs are absolutely soaring. Some saying that the airlines will have to reduce guidance on this.
It's going to get expensive. Abby, thank you. Futures, they recover a bit. We're down 0.25% on the S&P. Coming up, President Biden reiterating his unwavering support for Ukraine.
We're committed.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Russia invades Ukraine.
We have proven our strength.
The nature of this war changed yesterday.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
Ground troops are closing in on the Ukrainian capital.
Swiss abandon neutrality.
And analysis of what it all means to you.
Energy is on the table.
We could see oil prices moving closer to 120.
There is a lot of interest to offload Russian assets.
Look to see more companies announce their exits from Russia.
Keep it tuned to Bloomberg Television and Radio.
We're committed to helping Ukraine defend itself and in support of the humanitarian needs of the Ukrainian people. And we're coordinating on everything from sanctions to export controls and broader global issues of energy security, climate, and human rights.
The war in Ukraine front and center, complicating matters for President Biden, looking to ramp up Russian sanctions while reining in surging prices for Americans.
I understand our top priority must be getting prices under control. Look, our economy roared back faster than most predicted, but the pandemic meant that businesses had a hard time hiring enough workers to keep up and production in their factories. The pandemic also disrupted the global supply chains.
Let's get to Bloomberg's Mike McKee. Morning, Mike.
Morning, John. Well, I've got some good news and some bad news for the president. We don't have a lot of episodes like this historically, but we do have one instance in which oil prices reached levels that they're approximately at now. Could go a little higher. And that was 2008, before the financial crisis. And as you can see, what we saw then was gasoline prices following oil prices up, and that's the bad news for the president. The good news for the president is in that yellow line. That's the amount of oil produced in the United States. As you can see, we produce a lot more here than we used to, and it is a little bit less price sensitive than it used to be. So as prices go up, we are likely to see gasoline prices rise. But again, you go back to 2008, and that increase was relatively short-lived. Now, here's the danger. Looking at the February CPI, which is going to be the number of the week on Thursday, it's forecast to go up 7.9%. Oil is up 27%. You can see the weighting in the CPI, 27% since the war began. Gasoline up 16%, and wheat futures, which I'm using as a very rough proxy for food, up 61%. But at the same time, used cars, housing, and other parts of the core rate have been slowing. They're flat or falling in the last couple of months. And what that means is going forward, there's going to be an even greater divergence. You can see the big divergence there on the right-hand side between the headline CPI and the core CPI. Core isn't going to rise anywhere near as fast as headline. Consumers are going to be looking at the headline, which is a political problem for the president. The Fed is going to be looking at the core, which may restrain some of what they feel like they have to do. It's still too early to make a firm prediction, but based on history now, the Fed and the president may have diverging goals here.
Mike McKee, will the consumer wake up to a newspaper with the front page with an 8 handle? Thank you, Mike. Morgan Stanley says yes. This is their forecast. We see food prices up 0.9% in February, energy up 4.6%, together lifting the headline CPI up to 0.87% on the month. Year on year, 8% from 7.5. Julian, you can have this one. We ignored payrolls. Can we ignore that on Thursday?
The market does a reasonable job of ignoring the data. I mean, look, think about it. With this kind of data series, the last time we saw inflation of this nature yields were 14%. Obviously, that was 40 years ago. So there is a certain extent that it can be ignored because the geopolitics does take center stage. But it really calls to question this whole debate that we've left the great moderation officially. We left it a year ago. And in a higher inflation regime, what's the right multiple on S&P 500 earnings? That's the real debate.
Well, Victoria, can I throw that question at you?
Absolutely. I think it's going to be an 8% handle, and I think the market will absorb it pretty well because you can just feel it. And I think gasoline's going to come up. Right now, we're 100%. Commodity prices are pushing up the market, and the Fed's got to move. Probably just 25 bips. You know, they backed off the 50, but we still think, 5 to 6 rate hikes. And I know that's a little bit different than 91. They didn't move in 91 when crude moved up. And obviously 07, 08, you were already seeing the markets kind of turn by the time before crude fully bubbled. But look, crude in this area has never been good, and it's always been followed by a recession. I'm not trying to be too Debbie Downer. I know the R word's a bad word right now. But if you look historically, when crude has started to bubble like this, when all your prices are coming up like this, and regardless, let's say we can find a solution that's acceptable in Ukraine quickly, I don't think sanctions are going to go away quickly. I think we're going to simmer back into a Cold War, and that's just going to drag on global growth. There's no way around. Europe's almost in a full bear market, and I believe they're going to have a recession fairly shortly just because of the pressure Russia's putting on them.
Strange things happen when crude goes through 100. We've talked about that repeatedly. It can look through history all the way back over the last 15 years or so. Julian, you talked about the loss of the peace dividend, the post-Cold War peace dividend. How important is that, Julian? Do you actually take that kind of thing seriously? What would that mean for this market?
It's definitely important. Look, at the margin, if you look at it, the last 30 years multiple has averaged 6 turns higher than the prior 30 years. There's a lot of things going on. Obviously, rates are much lower over this period, and they still are very, very low. But the psychology is changing. The psychology around a more persistent geopolitical instability, a more persistent inflation, and that's going to put a damper on what investors are willing to pay for what we think is still going to be, mid to high single-digit earnings growth this year.
Jay, you're more constructive on the global outlook than most people we speak to, and that's fine. That's your view. That's for the future. The future will dictate whether you're right or wrong. It's not for me to say you will be or you won't be. What kind of multiple do you put on this market when Julian and Victoria have those kind of thoughts?
Well, I would just point out, John, that, $100 oil today is not the same as 10, 20, 30, 40 years ago. Personal consumption, the U.S. average spend on energy right now is about 3.5%. It peaked in the late 70s at over 7%. There's nowhere near the effect on the consumer. Inflation expectations not unanchored at all. 2-year, 5-year, 10-year inflation forwards, all at 3%. The idea that the Fed has lost control is a media myth. On valuation, look, the U.S. is not my favorite region. I'm underweight the U.S. I'm overweight non-U.S. Europe sells at 13 times earnings. Emerging market sells at 12 times earnings. China sells at its cheapest valuation relative to the U.S. in the last 20 years and has a much better policy mix than the U.S. does. There are lots of opportunities out there. I think Europe will emerge from this a much stronger, much more integrated and cohesive region. Yeah. And equities are being sold at bargain basement prices right now, especially the banks, John.
Well, the banks are 25% lower than the last time you told me to buy the banks. So we're going to come back to you on that, Jay. Victoria, Julian, I'm not letting that go, am I? Futures recover, almost unchanged on the S&P, down about 0.1% on the S&P 500. Coming up, the morning calls, and later, European bank stocks sinking to their lowest level in more than a year. What a vicious...
We can all recognize potential, but to truly unleash its power, we need a tool that takes us beyond the surface, that opens up entirely new dimensions of possibility, allowing us to harness this power with the knowledge, security, and speed to put us ahead of the curve. Copper, the unfair advantage.
Falling energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
In a few words, what a turnaround. For the S&P 500, futures were down more than 2%, now down 0.1%. For Brent crude, a bear market and a bull market in a single session. We were up 18% or something like that, close to 140. Look at this now. Positive just 1.74%, 1.7% to 120. That's the price action in the morning calls. Wedbush downgrading Ralph Lauren to neutral, forecasting slower revenue growth due to its outsized exposure to European consumers. Argus downgrading DraftKings to a hold, expecting a tougher macro environment amid increasing competition. And finally, Jefferies downgrading Citigroup to hold, identifying a number of upcoming headwinds during the bank's Investor Day. Coming up, the big banks under pressure, the war in Ukraine fueling monster losses in both the US and European financials. Going into the opening bell, a monster turnaround in this market. That's next. This is Bloomberg.
I'm here at the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The United States is having an active conversation about banning the import of Russian crude. The Germans this morning with just one word: no. No. Futures turn around in a massive way. Futures are negative just 0.2%. They were negative more than 2 percentage points. On the Nasdaq, we're down just 0.1%. Let's see opening bow, switch on the board and go straight to crude. What a turnaround here too. Crude has gone all the way from close to 140 and back down to south of 120. Right now on WTI, 116. We're positive just 0.4%. What a monster turnaround. Yields, I'm not sure what the bond market should do with any of this. We're up 5 or 6 basis points at 178.71. And the euro was deeply negative, a break of 109, and it comes back. We're down just 0.1% at 109.20. The whole market, trillions of dollars worth of assets trading like a penny stock in the last 12 hours. Let's get to the movers around the opening bow, 30 seconds in. Here's Abby.
What a wild morning indeed, John. And despite the fact that we do have crude off of those 18% highs on Brent crude, to your point, a bull market and a bear market in a single day, we still have energy movers leading the way. ExxonMobil and Schlumberger are both higher. The energy sector up about 1%. On the other hand, you have other pockets of the natural resources market not doing quite as well. Copper is down, so Freeport-McMoRan is down 2.8%. Albemarle, the chemicals and lithium company, earlier lower, now up about 0.6%. For a truly wild move, though, let's take a look at Bed Bath & Beyond. Right now, it is up 77%. Its best day ever, going back to 1992. And this, of course, is the Chewy founder and GameStop chair Ryan Cohen is taking a 10% stake, looking for a sale. Uber is up 4.7%. They have pre-announced the upside, raising the outlook. The rideshare market is really coming back. You can see that here in New York City. And then Occidental Petroleum higher with the wild action in oil, but also you have Carl Icahn selling his stake as Berkshire Hathaway is boosting their stake. So some green on the screen there, but yeah, wild, wild, wild.
Abby, thank you. This is such a tough market. If I sat here with you yesterday evening when crude prices started opening up and we approached 140 on Brent, would you have told me at the open we'd be down 0.1% on the S&P? That's where we are. European banks have been getting hammered over the last couple of weeks. Looking at that, here's Kaylee Lyons. Say, Kaylee.
Well, John, they were getting hammered earlier today as well, but what was more than an 8% loss on the Stock 600 Bank Index is now only a decline of about 1.5%. But of course, that is today alone. It has been brutal for some of these stocks in the last couple of weeks. The likes of Raiffeisen, of UniCredit, of SocGen, the three banks with the biggest exposure in Europe to Russia out of the European banks. Of course, all of those are also off of session lows, down between 2 and 3%. But we saw double-digit declines earlier on in the session, and all of them are down more than 30% on the year. Of course, they are at risk of direct hits, the likes of rising loan provisions, write-downs, maybe even having to pull out of Russia entirely. But there are also the ripple effects of the invasion that could weigh on the sector more broadly, like the pushing back of expectations of when the ECB will hike rates. If we see rates lower for longer, that removes a big part of the bull thesis for these European banks. So while they were outperforming earlier this year, they are now lagging the broader European market and lagging it quite hard. And just a point on how far valuations have come down. As we've seen this index fall 20% in just the last 8 sessions, they are now trading at only 51% of book value. But as we know, John, banks actually haven't traded at book value in Europe since the financial crisis.
It's been a while, Kaylee. It's been a while, that's for sure. Kaylee Lyons, thank you very much. Jay, I promise you'll have your time to talk about this. Victoria, I just wanted to come to you for a moment. What do you make of a market that approaches 140 at the open on Brent, comes back down to 120? And we're talking about huge markets. I understand that relative to the equity market and fixed income, there's not much depth in, say, a physical market like the commodity market. I get all of that. But seriously, walk me through this, Victoria. What kind of a market is this to be up 20% 1 second, up more than that on Brent, and then be back down to almost flat?
It's definitely one that's moving at warp speed. And it's almost like when we came off of the COVID recession, that we had an entire recession and recovery in like 90 days. The crude market is just kind of almost adding on to that and moving at warp speed. I think you're going to see these huge moves as we get more news out of Russia and Ukraine. And obviously at first it was, oh man, sanctions are going to completely cut off Russian natural gas and oil. And then it came out with Germany with that resounding no. And we may go it, but it looks like Europe may not. So then obviously you saw prices come back. I think think you have to be a little bit patient, and you have to realize this market's going to move very, very violently as we get new news. So let's say, hopefully, we get a ceasefire. You know, Russia finally came out with their terms today of what they're looking for. And you might actually see crude prices continue to come down if we can find some sort of resolution on the near-term horizon. Now, I think Russia's going to have sanctions still. I don't think we're very eager to really just forget what happened here if we can even get it resolved. But I actually look very positively at the fact that they came out with even, hey, this is what we're really looking for. And I always will go back to that Sun Tzu quote, you know, if your enemy's retreating, build them a golden bridge. And did we just finally find that out and that way to find a push forward to a peaceful resolution and negotiations? And when even China is saying you have to negotiate, that's when you got to start getting to the table seriously.
Well, Julian, I wonder if I can pose the same question to you. I understand the range of outcomes is incredibly wide here. 140 at the high end overnight, approaching that on the prospect of perhaps taking all of those Russian barrels off the market, for the US market at least. And then the Germans saying, no, I get it. But then, Julian, what you face as an investor is an incredibly wide range of outcomes. As an investor, what do you do in a market like that one?
So the temptation is to react to everything. And we would suggest that you just have to change your psychology to understand that this is an extraordinary time where you're seeing bull and bear markets all in the same day. And John, you haven't even put up, I don't think, the price of London natural gas yet, which is, you know, really outdone all of them so far today. Just extraordinary. And I think the key is we've had some conversations which, quite frankly, have been surprising in recent days, where people are actually nervous about holding cash because they view it as a depreciating asset in an inflationary environment. And while that's true over the long term, cash is very, very useful here because it enables you to keep your psychology sort of dispassionate away from these moves. And when the time comes, when there's a clearing of events, which we think there will be, you're prepared to act.
Stuck between a rock and a hard place, Julian, as you just described, even to go to cash. I'm looking at the European banks and where we were at the high of this year. We're down about 27% since then. Jay, let's come to you on that. Why you want to stick with this trade still? On the way up, of course, you were right. You were talking about the ECB introducing the prospect of interest rate hikes. That seems like it's dead and buried. It's gone. Why do I want to buy them now?
I don't know, John. Would you rather have buy oil today at 140 or European banks at half a book?
It's a good question.
I'll definitely take European banks at half a book. And that's what we have on offer today. And look, Morgan Stanley put out work over the weekend that the price action in the banks before today far exceeded the maximum potential loss from Russian and Ukraine exposure by the entire European banking system. So it's already well in the price. And to me, these things are opportunities. I mean, we run global multi-asset model portfolios, as you know, and it's been a golden age for asset allocation. You don't have to own energy stocks up here. I mean, I do. We took some profits weeks ago, probably a little bit too early. But I think selling energy here on a spike with the broad commodity index and backwardation at the most it's ever been makes a lot of sense. Book those profits, revert and put them into things that are selling at dirt cheap levels, oversold, maximum oversold, like European banks, like airlines, like the carbon credit system in Europe, which is down even more than the banks. I think there are opportunities across the board that are being presented here. And I would just suggest that the big story is COVID's ebbing and the reopening of the global economies, and the oil at these levels, as I pointed out earlier, isn't even halfway in terms of eating the pocketbook that it was when people casually refer to the 80s and the 70s. Completely inaccurate.
Well, Jay, I want to come to you on just a couple of things. Let's pick out on one. You framed it in an interesting way. Do you want to buy crude up here or banks down here? And a lot of people might sit there and say, OK, banks down here. But can you talk to me about time horizon? Because you often shape this investment as an investment over a long time horizon. Is that just a short-term tactical trade? Or do you have reasons to believe that through this cycle, and I have no idea if this cycle is going to last that long from here, who knows, but do you believe this is something you want to own through this cycle? Because if you believe that, you've got to believe surely that the ECB comes back into play, and so many people have their doubts about that still.
Yeah, John, I think that's an absolutely spot-on question. You talked about earlier markets having, going crazy in the volatility. You absolutely have to ride through. You have to have asset allocation. You have to have a process and a plan in order to succeed in these markets. And so you can't trade something that moves 20% in a couple of hours, and you shouldn't try because you're for sure going to lose money. And so the way I think about it, Morgan Stanley and others cut their European growth estimates for this year, cut it to 3%. The average 2015 to 2019 GDP growth in Europe was less than 2%. So even after all this, John, growth is going to be significantly greater in Europe this year than in the pre-COVID period. And I think that is sustainable. My view is that we're entering a multi-year period of better than expected high nominal growth rates and low and still negative real rates, which is quite constructive for equities where earnings expectations, as Julian pointed out, are single digit in the US and Europe. The bar is low. The bar is not high. It is low. I think we're going to have a resolution of Russia in the next couple of weeks. Time is not Putin's friend. He's completely reiterating the same demands he made last week. He's made no progress on the battlefield. Near-term resolution, oil reverses, banks rip, carbon rips, and please have me back on.
Jay, Will, let me ask you this, though, and this is not a snarky question. I'm being deadly serious. What would make you dislike European banks, Jay? What would do it?
Yeah, I mean, it's simple. It's simple that we would go into a recession. We're not. We're talking about 3% growth. That's what people aren't getting. This talk about stagflation is completely inaccurate. We're going to have nominal growth rates in the U.S. of 6 or 8%. Pre-COVID, it was 3 to 4%. We're going to have nominal growth rates in Europe of 5 to 6%. Pre-COVID, it was 2 to 3%. It's a completely different environment. People are not getting that it's a completely different environment. The market is betting we go back to pre-COVID. I'm presenting a different view, which I think has a reasonable shot at success. And if I'm right, the positions we're in are going to do well. And look, we're taking some pain. I mean, our model, global multi-asset model's down about 5% year to date. It's not great, but it's not horrible given where we're at. And we got a lot of things that, like banks, like carbon, like jets, all down 20%.
It's brutal.
And I think we're going to see that upside in the next couple of months and quarters.
Well,
growth
the ECB,
is going to be much
for
better.
sure. The ECB on Thursday, Jay, hopes you're right, without a doubt. If you're President Lagarde, and I'm listening to Jay Pelosi, I hope to God that everything you just said materialises. It's a lot more difficult, though, at the moment, Julian, for a lot of people to believe in that story for the year ahead. Julian, you see the upside in the US equity market. Let's not bury the lead for you. I have buried the lead for you. Let's finish with it. 4,800, down from 5,100. Why still anywhere near 5K? Why, Julian?
I think Jay really hit it, because even though we're going to have a growth slowdown, we are still going to have strong growth above the trend of the last number of years, both here and in Europe. And without talking about, how quickly Russia is going to resolve itself, rates are still low on a relative basis and in an absolute basis as well. And again, for us, there are two things. If there isn't going to be a recession, you could go down 15 or 20%, but you don't go down 25 or 30%. And the earnings growth trajectory is likely going to be very supportive as we get to the second half of the year.
Victoria Green, you get the final word. The final word, please.
Respectfully, I think it's very important that you don't invest in value traps right now. Some places are valued the way they are because of what it might look like for future growth. And what happened with Russia is a fundamental shift, right? It actually should change earnings trajectories. We are still bullish on the United States. We do think this is going to be a drag. While we may have resolved COVID, you take Russia off the table, you're not going to have the global growth that we used to think we had. So you have to look at this and understand this was a fundamental change to growth expectations. The commodities are going to bite the consumer a little bit. The Fed's going to move. We are moderately bullish on U.S. equities, but you have to look and say at some point in the next 12 to 24 months, most likely we're going to have a recession because we're going to overheat.
Victoria Green, Jay Pelosi, Julian Emanuel with a range of views. Victoria at the one end, Jay at the other, Julian somewhere in between. Coming up, the United States discussing a ban on Russian crude.
We are now talking to our European partners and allies to look in a coordinated way at the prospect of banning the import of Russian oil while making sure.
Back.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe ada 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
The no-fly zone, to be very clear about what that involves, is that means that if Russian planes violate the zone that's declared, we shoot them down. And that runs the considerable risk of creating a direct conflict between our countries and Russia, and thus a wider war, which is in no one's interest, including in the interest of the Ukrainian people.
That is not something, a position that this American administration supports right now. The Ukrainians are asking for it. The Russians are saying, don't you dare. And America is saying, we're not interested. Secretary Blinken also over the weekend making several headlines. An active conversation about banning the import of Russian energy into the United States of America. Well, the European allies joined. The Germans this morning pretty clear. No, no, no. Julian Lee joins us now for more. Julian, this is such an interesting market at the moment with really wide range of outcomes, a really wide range of outcomes. On the one side, you ban Russian crude. On the other side, seemingly you don't. Julian, what on earth do you do in the oil patch right now?
I think it's an extremely difficult situation. I mean, clearly, it's much, much easier for the US to ban imports of Russian crude than it is for several European countries who are much more heavily dependent on it and have much less in the way of alternatives. So, maybe what we're looking at is much more of perhaps a piecemeal approach, perhaps a degree of self-sanctioning that we're already seeing with some countries banning Russian ships, perhaps banning Russian cargoes in time, import bans in those countries where it is feasible to do it. We're seeing a tremendous rise in crude oil prices, but we're also seeing a big rise in the discounts that Russia is having to offer for its crude, so it's not getting anything like the sort of headline prices for its oil exports. And maybe this is, at best a way of putting incremental pressure on Russia without perhaps being able to turn the taps off fully in a single go. But the other thing I think to bear in mind is we've had this announcement of a release of oil from strategic reserves held by member countries of the International Energy Agency. That organization or its members hold about 1.5 billion barrels of oil in strategic storage. The release that's been announced to date is for about 4% of that. So there is a lot more that can be done to release oil from strategic stockpiles. And I don't think this is going to be a sort of one and done with strategic oil releases. There are going to have to be more. And that may be a way of limiting the impact of reducing imports from Russia.
Well, Julian, I want to pick up on the self-sanctioning. And if the team in the control room can bring up that quote from Shell, the statement that we had from them over the weekend. Julian, this was fascinating to see Shell essentially justifying, almost apologizing for buying Russian crude at a discount, turning around and essentially saying the money we make on it will hand over to a charity. Julian, as you point out, we are already self-sanctioning. The oil producers feel embarrassed about dealing with Russia already. And I just wonder what the broader ramifications, the consequences of that are going to be going forward, even if, as you point out, the US don't make this decision.
I think that the ramifications are going to be that there is going to be a lot less Russian oil, whether it's crude oil or refined products, that finds markets in Europe or in North America. It's quite clear that there is a strong degree of public pressure against these trades. Shell, I think, as a company, if its corporate memory is long enough, will be very well aware of the damage that public outrage can do, not just to its reputation, but to its bottom line. I mean, I can remember the days of Brent Spar when they wanted to basically sink an old production facility in the North Sea. They eventually backed down because customers stopped buying their petrol and their diesel, particularly in countries like Germany. And if we see that kind of pressure on oil companies again, then I think we are going to see a significant reduction in the volumes that Russia is able to sell.
We're introducing a reputational issue here as well. Julian Lee, thank you, sir. Abby, we've talked about this for weeks now. It's company after company stepping back from Russia.
It certainly is, John. Just an absolute exodus. Any company that you can think of really has pulled ties from Russia, really cutting their ties from Russia, that self-sanctioning that you're talking about, sanctioning on their own, whether it's VW, Shell, IKEA, and Shell, of course, that controversial buy on Friday, causing them to do that interesting apology over the weekend, Netflix, Nike, Disney, and it's really hurting the Russian economy. If we take a look at what happened in 2021, big growth for Russia, energy at 59.3% export contribution for them, overall 46%, credit cards out to credit cards, Russia apparently reaching out to China, but it seems that these self-sanctions are working, cutting Russia off from the world, John.
Abby, thank you. 23 minutes in, stocks down 9 cents. Your trading diary up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Down not even 0.1% of the open, now down 0.7% on the S&P. For the crude market, a massive turnaround from where we were overnight. That's the price action. Here's your trading diary. President Biden discussing the war in Ukraine with European and UK leaders at 10:30 Eastern. European GDP coming up on Tuesday. The big one on Thursday with US CPI, plus an ECB rate decision and President Lagarde news conference. And finally, University of Michigan consumer sentiment to close out the week on Friday. From New York City, this was the Countdown to the Open.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
898, I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing
called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
I miss you, oh, 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 oh. I do, but I got pride too. I miss you, oh, 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 oh. I do, but I got pride too. Used to call you even when we argued, had it set on default. Everything was my fault. I jump out in this